Hi, Brad Macbeth here. We are living through some extraordinary times. I'm not going to say that nothing like this has ever happened before, but certainly the combination of the coronavirus pandemic and the market correction, or at times what felt like a meltdown, uh, are really quite something. Breathtaking would be the word. Now, interestingly, probably the number one question I get from people is, well, is this a great time to invest? Or I see all sorts of questions in a bunch of the groups I'm a part of, like, hey, what stock's on sale? What should I be buying? Well, today I wanted to maybe throw a little cold water on that fire. Listen, my first question for people who ask a question like that is, well, what have you been doing for investing up until now? Because what you're talking about doing is timing the market. And timing the market historically has been a disaster for almost everybody. There are some who do well at it, but the vast majority don't. And anytime we enter with emotion into picking things, picking winners, whether it's picking the time or picking the investment, we generally tend to see things go sideways. So what I wanted to share with you today is just some historical information to put things in a bit of context. And of course, the answer that most people give me to the question of what have you been doing up until now for investing is often as not nothing. Because if you're the kind of person who actually has cash on the sidelines that you've been waiting to invest until this particular time, then you're probably not going to be asking me that question. And you're certainly not going to be posting in Facebook groups. By the way, a lot of those Facebook groups are full of people who are broke, trying to get out of debt. That's why they're in these financial groups. So, be very cautious about where you're getting your advice. So let's look at historically what's gone on through a number of very substantial market corrections. Let me just share my screen here. So what we're going to look at is a number of stock market corrections that have happened throughout time, just to see what went on in these various periods of time. And it took me a fair bit of organizing my thoughts and notes here to be able to give this some context. So let's start by looking at probably the most famous one, and that, of course, is the market correction that brought in the Great Depression. Now, what I want to look at particularly with each of these corrections is a few things. What was the high before things went sideways? What was the bottom? How far did it go down? What was the percentage loss? How long was it from the top to the bottom? And then how long was it to get back to the previous high? Because you can get some great bargains for sure if you know when the bottom is. But of course, we never know when the bottom is. We always see it in retrospect. So let's have a look here. We'll see here. Let me turn on my marker. All right, so we see here, this is the market high over here. That took place in September 1929. And this is the big drop that happened right here in October of 1929. So there was a peak in September, and then the really big slide, what we call Black Friday, happened on in October of 1929. Now, the numbers are a little different back then. So I'm referring to the S&P 500 here, which is the broad market of US stocks. So the high in the week of September 2nd, 1929, was 31.86. Now the bottom, that's all the way over here, the bottom was 4.4. And you go, well, that's a very small number. Look, that was an 86% drop. 86% of the market value was wiped out by July 1932. So that's almost 3 years. It's 34 months it took to get to the bottom. Now here's the really scary thing. And this is what sets this drop apart from all the rest. That to get back to where things were at on the high over here in 1929, you have to go all the way over here to September of 1954. So that's a 25 years. So if you had all your money in the market here with nothing else to invest back when it dropped, it was 25 years before you get back to where you started from. So that was obviously a catastrophe of unprecedented proportions. All right, let's look at the next one. And I'm not picking them all because there's lots of them. This next one happened just after the Second World War. The peak was here in May of 1946. And that day it was 19.25. You go, wait a minute, 19.25, that's not even as high as it was back in 1929. Well, that's true, because remember, it took all the way to 1954 to get back to the high from 1929. All right, so we were at a high of 19.25 in May of 1946, and it dropped down to 13.55. It was a 29% drop, and it took 37 months. That doesn't seem right. That's February 1948. Sorry, that is not 37 months. That is a little under, it's probably 27 months. Anyway, it's a little under 2 years to get to the bottom. 29% drop in that period of time. And then it took till September 1950 to get back to where it had once been. So again, 4 years to get all the way across to here again. Okay, so 4 years to get back to where you were from the start. So the next one that we're looking at is in December of 1961, this started. So it starts here in 1961. And this one actually was relatively contained. It went from 72.64 down to 52.32. That's a 28% loss from here to here, 28% drop. And then it took until June 1962 to get back to where it had once been. That is 6 months to the bottom. Sorry, that was the bottom. June 1962 was the bottom. 6 months to get to the bottom. And then August 1963 to get back to snuff over here. And that is 14 months. So that one was fairly contained, fairly brief, still sharp. Now, I've skipped a whole bunch because I could sit here for an hour and do these. And I went to, we're now coming into the ones that we all tend to know and loathe. And so here we have what's referred to as Black Monday. This happened in, well, Black Monday was actually in October. The market peak prior to that was in August of 1987. So that's where we are here, August 1987. And quite a precipitous drop. That one particular day, what's referred to as Black Monday, was up until then the worst single day drop in the history. And at the peak, it was at 337. Well, let's call it 338. It dropped to 221. That's a 33% drop. And that drop, the bottom was in November of 87. So August to November, only 3 months to go from the top to the bottom. And then 2 years, July 89. So quite a rapid climb out again to get back up to where it had once been. And that's 2 years. So there was quite a lot of turbulence, a lot going on right then. But believe me, it looked very dismal on Black Monday, like the world was ending. And then 2 years later, you know, the market had gone up like crazy from that bottom. All right. This is August 2000. This is the dot-com bust, the great tech bust. And it actually encompasses two events. August in 2000, we had the dot-com bust. And then you'll notice things plummet down to here. And that gets us to 9/11. There's a little bit of an uptick. And then plunges down again. And so the bottom of this one, let's just show us where this one was. This one, the peak back when you could buy companies, crazy internet companies that had never made a dime and never would, as it turned out. You know what? All of those ideas sounded so ridiculous back then, or it's just really, they were way too soon, because they've all come to pass since then, almost all of them. But back then, you know, shipping dog food around seemed like both a great and an absurd idea. But really, the truth was the marketplace wasn't ready for it. Of course, now people buy toilet paper on Amazon. So the top of that was September 2002. Sorry, the top of that was August 2000. The high was 1,527, and it dropped all the way to 776, down here to 776. And that took 2 years. September 2002, so a year after 9/11, was the bottom. And then it crawled out of there, but it took 5 years to get all the way back to where it had once been. So a 5-year gap to bridge this divide, get back to where you once were. Now, here's the one we all remember. The debt crisis, October 2007 was the peak, and it peaked at 1,565. Okay, now wait a minute. That number sounds almost familiar. What is that number? Well, the high before the dot-com bust was only 1,527. So it took, by October 2007, we were really only back where we'd been in August of 2000. And then this happened, right? Some really catastrophic drops. That was the bottom of that. So it went from 1,565 down to 682. A 55% drop. And the bottom was March 2009, March 9th, 2009. Now, let me tell you about that one, because that one, I was working in this financial services industry by then. And holy smokes, you know, March 9th, 2009, we weren't all running around the office high-fiving that we'd finally hit the bottom. Things were pretty terrifying at that point, because it had dropped so much and so far. And the world was in a global debt panic, starting to come out of some of that panic by that point. But we had no idea that was the bottom. You know, the big question was, how much farther down can it go? March 9th, 2009 was that bottom. And that bottom was 682. The market was down 55%. Okay, so let me put some of these numbers. Actually, I'll come back to that. All right, and so it took 18 months to get to the bottom, and then it took a total of 6 years from peak back to the same level, 6 years. So from here to here, this high back in 2007, back to the same high, 6 years. All right, that's another giant crossing. Okay, so when we ask the question, what's going on now? As I'm doing this today, you know, things have come back slightly. Here's where we've been. So this is just, you know, people are really kind of panicked right now, but, you know, we've been on a fairly good run here from late 2018 even, up to the peak that happened in the week of February 10th, 2020. And I'm only 6 weeks past that right now as I'm doing this. And in 6 weeks, this is what happened. We went from there to there. Now, we've actually had a little bounce up in the last couple of days. So the question is, where are we? What's going on? And so this was our peak here. And our plunge here at the bottom got us to down about 33%. Now we've bounced up again, but there's lots more turbulence to come, because tomorrow the United States Congress is going to pass a bill enabling what is now a total of $6 trillion of spending. So 2 trillion out to the, I'll call it the public, the general public, and 4 trillion that the Federal Reserve is going to spend. $6 trillion. Other countries are doing many similar things. Here in Canada, similar madness, spending going on like has never happened before. And those are the times. Is that going to have an effect? Of course it is. And of course, last week, millions of people in North America applied for unemployment because they were laid off. So they applied for unemployment benefits. So the question is, what's going to happen? And the answer is, we really have no idea. But I can tell you, in going back and looking at these corrections, they never lasted only a couple of months. They never lasted less than a couple of years. And one of them took 25 years to go from peak to peak. So when you're thinking about what's going on, you want to be thinking long term, not short term, like, oh, I'm going to put money in. Because let's say tomorrow you put a bunch of money in the market thinking everything's on sale. And it is. It's off by, I don't know right now, today where things landed, you know, maybe it's only 24% on sale. But either way, there's no certainty that things won't go down quite substantially again. This could be one of those things that drops 50% in total from peak to valley. And if that's the case, that would see you losing about 30% of any money that you put in today before it starts to come back. And it could be 5 years to get back to where it was before. So, you know, if you've got cash, if you're not borrowing money for this, if you've got actual money you want, that you were always planning to invest, and you have the stomach to potentially ride this thing another 30 or 40% down before it turns all the way back and starts heading up, and takes another 2 or 3 years or whatever to ride back to the previous peak. In other words, you can endure comfortably 5 or 6 years of churn, which might include within there a 30% loss of the money you're putting in now. Then sure, maybe that's the right timing for you. But otherwise, think very carefully. What you should have been doing all along is systematically investing. And by systematically investing and continuing to systematically invest now, you're going to ride the market ups and downs, and you're probably going to do okay. Over a long period of time, you're going to do 7, 8, 9%, depending what you're investing in, if you're investing in equities. So that's just really the reality of where things are at. I really urge you to very carefully consider how things can go, because they can go very hard. They can go very wrong. And we are truly in an unprecedented situation with the amount of money that the government is spending. What effect that's going to have is quite uncertain. We're facing massive temporary, we hope, unemployment, but it is massive, and businesses are going to fail. And we don't know what the effect is going to be on the economy. The interesting thing is that we perhaps weren't in a fundamentally flawed economic situation at the time. You know, back in 2007, there was a lot of craziness that had gone on with debt all over the place. And that really was toxic in the system. However, there's still a massive amount of debt out there, especially personal debt. And what effect that is going to have on everyone everywhere if people are defaulting on that too is uncertain. So we're living in very challenging times. Be wise and have a plan that's for your long-term benefit. Don't be reactive and taking decisions to do things like, hey, the market's way down, I'm going to dump a bunch of money into these 3 stocks that I think are really good. That is just reactive and very dangerous, unless that's something that you have made yourself an expert at. Anyway, I hope this has been helpful to help you consider what's going on and how you might think of it in a historical context, because there really is nothing new under the sun. The question is, with what's going on right now, what is this? Is it one of those or is it one of those? We don't know exactly yet. We will know when we look back, but predicting it is a very dangerous game. Okay, one last point I wanted to make that I realized after I'd done the last segment. You'll remember that I pointed out that from here, the peak in 2000, it was to the next peak, which was the beginning of the crash of 2007, 2008. That's 7 years. But of course, then we had the next big crash, and it was another 6 years before we got back to that same level. So from here to there to there, that's 13 years. That goes from August 2000 to February 2013, that there was no net growth in the market. So when you think about how sophisticated you are and how you're going to time the market and all those great ideas, remember, you really don't know exactly what's going to happen. You're much better off investing systematically over long periods of time. And for those who ask, what is a long period of time? Well, here we have, now this is one of the worst periods ever, not the worst. The worst was 1929 to 1954, but that seems long ago. But this one was recent, and it was 13 years of no net growth. So keep that in mind in all your deliberations. Investing is not as much about taking advantage of opportunity. The opportunity is that the market systematically goes up over long periods of time, not that things go up and down and I can take advantage of figuring out when they're going to go up and down. But rather, the opportunity is that if we invest systematically over long periods of time, we will enjoy good net gain over that long period of time. So take advantage of that. And if you're not already doing that, make a plan to do so, starting today. Oh, and by the way, the market is down another 5% today, just so you know. All the best. If you've got questions, post them. I'm happy to answer them. Thanks very much for listening today.